Thanks, Dave, and thanks everyone for tuning in today. Had a lot of great speakers, and we're going to hopefully keep it rolling here. And I'm going to be talking about day trading, the E-mini futures, specifically talking about how you can use the first 90 minutes of the day to really capitalize on your trading. So to give you a little bit of a outline of what we're going to go through here, we're going to talk about the simple tools that I use in my own trading. I'll pull a lot of examples from the E-mini S&P, but all of the tools that I use are going to be easily transferable to different markets, different time frames, but mostly I'm focusing on futures. And the next thing we'll talk about is how to identify quality entry points. We'll go through everything from the setups, the entries, how I manage the trades, and how I spot trades. And then what I find most important is how to get into a trade, but then also to stay in. And so it's, the setup a lot of times is the easy part. Getting into the trade is kind of the easy part. And staying in those trades, being able to hang on to those winning trades is really what makes you successful as a trader. It doesn't really do much good to get into a great trade and then have it run away from you. I'm sure we've all been there at times where you do get into a trade and you get out early and then it just takes off and you're sitting on the sidelines. So I have a couple of simple techniques that I use to stay in those winning trades longer. And I'll go through some of the trade management that I use as well. So who am I? What am I all about? Well, my name is Tim Racette, as Dave mentioned, and I blog over at eminimind.com. I've been trading for quite a long time, since about 2006. I actually got my start in Chicago. That's where I'm from, the Chicago area. And so I had the pleasure of the opportunity to go downtown and trade at the Chicago Board of Trade, and got to meet some really influential traders that helped me kind of shy me away from joining and trading down in the pits, and really pointed me towards the trading screen. And so, by the mid 2000s, a lot of the pits were already pretty quiet and thinning out even more so than they had been. But the computers and the technology was really taking over. I mean, since the late 80s, I got put in touch with some traders who'd been trading the E-mini S&P futures since the 80s on the computer screen, and that's what really kickstarted my online futures trading. So I day trade the E-mini futures. I've had the pleasure of speaking at a number of the Traders Expos and CME Group and things like that. Contributed to Futures Magazine as well. And I really like to get outside. So being able to focus for a couple hours in the morning to do my trading, and then get out of my office and get away from the trading screen, I think is really beneficial, because it helps clear your head, helps to keep you grounded. And as you know, when you're sitting there looking for trades, trying to manage positions, the worst thing that can happen is you start to get bored, you start to lose focus, and that's when you start to make mistakes. So I'm a big fan of getting outside. I like to explore. I currently live in Arizona. I like to ride mountain bikes quite a bit, hike, get outside as much as I can. Spend most of my summer in Colorado and South Dakota, and like to travel around as much as I can. So trading is a great vehicle for that. At home, I've got a two monitor setup, but primarily my trading screen and my charts are all on one monitor. I really just use the second monitor for my trade ladder, but when I'm on the road, sometimes I take a portable monitor, but if not, I can easily just trade from the laptop, and that's it. So I'm also ASU Sun Devil, and like I said, now living in Scottsdale, Arizona. So it's pretty hard to beat those Arizona winters when you're coming from the Chicagoland area. So that's a little bit about me. You can find, YouTube, Facebook, the usual places. If you just search eMiniMind, you'll find me there. Let's dive into a little bit about my my routine that I use, and then we'll get into some of the specifics on how I look for trades and get into various trades in the futures. So I'm a technical trader, as pretty apparent. Most of my trades are anywhere from a few minutes to maybe about an hour. If I'm in a trade that I'm managing, really just trailing my stop, that's when you get into those longer trades. I don't take any trades in the first 15 minutes of the day. I like to let the market open up, settle out a little bit, and then I can use some of that information from the first 15 minutes, the high and low points. Have we gapped up above the prior day like we did this morning? Or are we just opening within the prior day's range, the prior day's high and low? That kind of information, by looking for some of those same contact points, if you want to call them, where are we opening from the prior day's close? Are we above it? Are we below it? And then are we moving or gapping up or down outside of the prior day's range? Those are two really helpful starting points. And then just looking at some of the daily support and resistance is a really helpful pre-market exercise to kind of become grounded and be able to follow that same formula, if you will, or routine every morning. I'm a big proponent of keeping things simple. So the more you can, invest in yourself, in your mindset, to learn the skills and the psychological management of managing your emotions, the better trader you're going to be. As you saw in the pictures earlier, I'm very big into competitive mountain biking, and so I spend a lot of time outside training, and there's a lot of parallels with all kinds of sports to trading, and a lot of it comes from that mindset. So reading is really good. Even if you just start your day by reading a couple of pages of anything, doesn't even have to be a trading related book. It can really just jumpstart those creative juices and get you in a good headspace to start trading. So, and then it's important to remember that trading is really just a means to an end. So, really define where you want your trading to take you. Where does your trading fit into the larger picture? And having those long-term goals, they might seem a little bit silly at first, but no matter how good you are or good you become as a trader, there's going to be hard times and there's going to be really good times. And so to get through some of the challenging times doesn't necessarily mean that you've lost everything and you're starting from scratch, but there's going to be times where the markets are just not giving you a lot of good setup opportunities, and having that longer term goal is a really good way to stay grounded and keep focus on what's important and not overtrade yourself into a giant hole. So I think a lot of people like the idea of trading because they picture themselves sitting on a beach and clicking the mouse for 20 minutes and then going off and doing what they want. But just know that trading does take a lot of upfront time to learn, and there's a whole lot of information out there to sift through. So just like if you were going to become a doctor or a lawyer or any profession, there's going to be a lot of time needed upfront, time in front of the screen. and time to review, to place trades and review trades and build up your account and be able to get to a point that when you are standing on the free throw line and it's down to the wire, you can make that free throw effortlessly. And the reason you can do that is because you've made tens of thousands of free throws in practice with teammates that have a hand in your face and are making lots of noise, or you're standing on the green and you're 5 feet from the pin and you're making that putt. Well, you can do that when money's on the line because you've practiced that 10,000, 20,000 times with all kinds of distractions. So in the goal of freeing up more time so you can do the things that you want to do, it's helpful to be very focused and really give yourself some sort of process goal for the day or for the week. If you just set goals that are monetary, it can become discouraging if you don't reach those goals, or if the market is just quiet and not moving a lot and not giving you a lot of opportunities. So if you can set some process goals and find ways to be very focused and smart with your time, then you can really accelerate that learning curve and the trajectory. So the first thing I want to talk about, getting into more of the nuts and bolts of my trading, is the chart that I use. It's called a tick chart. It's slightly different than a time-based chart. So rather than like a 5-minute chart or an hourly chart being based on time, a tick chart is just based off of a number of transactions. So what I like to use is a 512 tick chart, and the chart itself really doesn't look any different if you were to just have a candle chart side by side. It really doesn't look any different except for that x-axis, where instead of 1 minute or a 5-minute or an hourly or a daily chart being the time frame, a tick chart just has a certain number of transactions that need to take place before the candle or the bar closes. So I'm using a 512 tick chart, and it's when the market's moving really fast and there's a lot of volume, the candles form really quickly. And when the market's moving really slow, or if it's after hours, after the regular trading hours, the candles can form really slowly. So I pair that with a Hakanashi candlestick, which is a slight variation to the traditional candlestick. None of this is proprietary, so whether I use Thinkorswim as my chart package, whether you're using Toss or NinjaTrader or anything else, the time aggregate of 512 tick chart should be available, and the bar or candle, or in this case Hakanashi, should also be available. So Hakanashi's, again, it's very similar to a traditional candlestick. It's just a slight variation to where the candles form by starting from the midpoint of the prior candle. So traditional candlestick chart here in this picture, and then on the right, it's the same chart, same time frame, only the Hakanashi candlestick is on top of it. And so you can see you get a little bit more. In this case, I use red and green as my colors, but if you were using black and white or filled and unfilled, you get a little bit more trending visually. And so that's why I like the Hakanashi. Helps clean up the chart and is a little easier on the eyes to spot trend changes. So if we pair those together, 512 tick chart and then the Hakanashi candlestick, it just gives a nice visual representation, and like I just said, it's easy to identify those trend changes. So if we look at two charts side by side, just a traditional candlestick chart, and then if we look at the Hakanashi candlestick, the downtrend, that's pretty easy to spot regardless whether you're using the Hakanashi or the traditional, but it's the the sideways action when you can see the swing highs and the swing lows stand out a little bit better, especially on a 512 tick chart where it's more of a short-term time frame. And so anything I can do to just kind of clean up my charts. I don't like a lot of clutter and indicators and lines all over it. So for me, the Hakanashi helps clean that up. And so that's the kind of the basis for what I use in my charts. The next thing I wanted to touch on is how you can identify the trend and some of the market structure that goes along with it. So we know that the market doesn't just go straight up and straight down. You have kind of these stair-step motion. And so within the stair-stepping, you have a lot of these, we call them swing highs or various high points and low points along the way. And so all of this, most of us understand the concepts of fear and greed and the human emotions that are tied to the markets. Any market doesn't just have to be the stock market. And most of us understand, the higher highs and the higher lows that make up an uptrend when we're piercing or breaking these swing highs, high after high, and then we're making a higher low and then another higher low. That's the definition of an uptrend. And you flipped it on its head, lower high and lower low, definition of a downtrend. Kind of to use the football analogy, we're getting back to the basics of blocking and tackling. So every season you want to come back, focus on the fundamentals, get those down so well that you can spot these trends. You can do your basic blocking and tackling under very high pressure game situations. So you're looking at the charts after hours in pre-market or when the markets are closed, doing some basic analysis, trend spotting, so that when the markets are open and things are happening really quickly in real time, you're able to process that very fast and in a way that you can then interpret that data and then turn around and make trade decisions based off of that. So just printing out a 5-minute chart of the S&P is a good starting point to just kind of mark up the highs and lows and identify those swing highs and swing lows and how they relate to the one prior, so that you can kind of highlight, okay, here's an uptrend, here's a downtrend, here's a sideways range bound, no trend area. Because even though we might go up in general over the course of the day, there's a lot of little trends that as a day trader, you're capitalizing on. The market might move 6, 7, 8 points, and that's enough to be able to capitalize at least a moderate trade in the midst of that. So let's talk a little bit about getting into a trade. And when you're attending some of these expos or sitting in on a webinar like this, it's okay to pull different pieces and include them into your trading. Maybe you pick up the 512 tick chart or the Hakanashi, and you have a strategy that you like, and you just want to incorporate one other piece into it. I would just caution you to not try to add too many layers, because if you start adding indicators on top of indicators and you have all these different criteria that you need to line up in order to place a trade, you end up never getting into a trade. You're just waiting. So the more you can simplify, the better. It's perfectly fine to absorb information, see what resonates with you. You might really like MACD and stochastic or pivot points. And if something really resonates with you, I would encourage you to go deeper and really become a master of it, as opposed to trying to go wider and incorporate all of these things into your toolbox. If you're going to hire someone to build you a deck, you're probably not going to reach out to a plumber. You're going to want a master carpenter. And if the more specific you get, okay, we're remodeling our house. Okay, well, now we're getting down, we're remodeling the bathroom. Okay, well, we want to tile a shower. Well, you get someone who all they do day in and day out is tile showers or doing tile work, they're going to be very, very good at their craft. And so the same thing goes with trading, all kinds of markets, different time frames, different approaches to take. The more you can focus in and just become a master of one thing, at least for starters, the better you're going to be at achieving success in that trading style. So for me, the way I like to get into a trade is I start by identifying, is there a trend or is there not a trend? And then I wait for that swing high or swing low break that we just talked about. So in this case, we have a high that breaks the prior high, and that kind of initiates, okay, we're potentially going into an uptrend. And then I use just a very basic, I use the Fibonacci tool, but I'm just pulling the tool to get a 50% retracement, or sort of the halfway point in the pullback. That's something that the pit traders will do, especially on like the hourly, the first hour of the day. Look at the halfway point if we can get a pullback, and then can jump in with the original direction. And so just doing that, replicating that on a smaller time frame by getting in at the halfway back point, or the 50% retracement. And I'm just using, placing a limit order helps with slippage. You don't have to be chasing the market and using market orders and things like that. So I identify that, hey, looks like we're breaking a swing high. Let us pull back to the 50%, put my order there, and then from there, it's just a matter of managing the trade. So mechanically, getting into the trade is not that difficult. It's the context around identifying the trend that's really where a lot of the legwork happens. So regardless of whether you're using 50% retracement to enter the trade, if you can really become very well versed in identifying the trend or lack thereof, you can really accelerate your trading. I like to use the first 30-minute high and low as a barometer. So market opens up, 30 minutes go by, and if we are still trading within that first 30 minutes, following the half-hour mark, so it's an hour into the day and we're still within the first 30 minutes, clearly we're stuck in a range. If shortly after the first 30 minutes go by, we can sell off or break out and get outside of that first 30-minute range, now you have a much more likelihood of going into a trending environment, and a lot better opportunities. It's just like if you were trading within the prior day's high and low, kind of an inside day, there's not as likely to be a lot of movement if you're just kind of stuck in a tight range inside the prior day. So looking for those days where you're at least, you don't necessarily have to open above the prior day's high, but once you move away from the prior day's range, you start to get more movement, and more movement means more trading opportunities. So once you get into a trade, what I like to do on the ES, I use a 2-point stop. I don't consider that super micro tight, but it's also not super big either. 2-point stop, and then I'll use a 3-point first target. And so what I like to do, rather than trying to decide, okay, am I going to exit the position at an arbitrary number? Am I going to exit the whole position at 5 points, or am I going to trail? I just cut my position in half. 3 points is the first target on the first half, then I'll trail the second half. So using that 2-point initial stop on the trade, getting in at the 50%, and then once the market goes 3 points, or 3.25, so that it trades through your order to get a fill, then you're out of the first half of the position, and then from there it's just really a matter of trailing swing lows. You can do a couple of things. So you can trail the swing low if you're long, Just every time you make a little pullback and then break out into a new high, just bring your stop up underneath that next swing low. I like to move my stop to break even. Once we break and make a new high, so if I draw up a retracement and I'm anchored to the low down here and then this high, once we break out and make a new high, I'll go ahead and move my stop to break even. And then, trailing the swing lows as the market moves up, as long as it continues in my favor, is a really good way to, let the market dictate when you should be getting out, as opposed to trying to pick tops and bottoms. If things really get moving quickly, then you can switch to trailing each candle. I'll do that a lot of times on a daily chart. If I'm swing trading a individual stock, just put my stop, if I'm long, I just put my stop, 10, 20 cents below the candle's low for the day. And so if you really start taking off intraday, you can just trail each candle's low if you're long, or each candle's high if you're short. And that way you're not, price isn't 10 points away from your stop and you're sitting there letting it come all the way back down to stop you out. So yeah, trailing the second half, a couple of different ways. That was first way there was just trailing the swing lows. You can also draw up the next retracement, or a 50% retracement, and use the 61.8 as your failure point, and just put your stop below that for a long. The swing highs and swing lows I just mentioned, and then trailing each candle when things really, nosedive off a cliff, and you are, 10 points or 5 points away from your stop, and you want to lock it in really fast without just hitting the flatten button to exit the trade. If you just do your best to kind of eyeball it and trail each candle by 2 ticks, sometimes they move really fast, and it's like, all of a sudden you're up 10 points, 15 points if it's a really hot, volatile day. But, you're going to end up a lot better off than just, like I said, hitting the flatten button and be out for 4 points when you might be able to get 14. So to kind of tie everything together, the tick chart and the Hakanashi, you don't have to use it, but I find that it helps give a clearer visual. If you like the 1 minute chart or the 5 minute chart, you could certainly use those. But really the tick chart, the Hakanashi and I'm only using that on the tick chart. If I'm looking at a daily chart, I just use a traditional candlestick. Intraday, on the 512, it's such a small time frame. The candles themselves don't mean that much, but as you get up to like a 15-minute, a daily chart, the open, high, low, close, and the shape of the candle can tell you a lot. Do we have a big body? Are we a hammer? Are we a spinning top? Those kinds of basic candle technical analysis can be helpful. So I always start with identifying the trend so that I can identify where the trend is changing, and that ties back to those swing highs and swing lows. If we're moving down, lower high, lower low, lower high, lower low, all of a sudden we take out a swing high. Okay, we have a possibility of a trend change, and I want to be getting into that trend change as soon as I can. And it's going to start on the smaller time frame, and then you'll start to see it on the next bigger time frame. So you see it on the 512 changing trend, then you start to see it on the 5 minute, and then the 15, and then the hourly, and then all of a sudden the daily trend is changing. Well, that starts from the smaller time frames. So if you use the larger time frame like a daily chart and look for that support and resistance levels, those can be good places to start placing trades. Or if you look at the high, low, and close from the prior day, you can often, find reversals at that level, at those areas. And then the entry itself is pretty straightforward. Once you get that swing high or swing low break, just using that fib tool, 50% isn't a Fibonacci number, but just using the tool for execution, drawing up that 50%, and using a limit order to place your trade at the 50. I like to put my order a tick in front of the 50 so that as price is coming down, it goes through my order and then touches the 50 and then it has to trade through my order, so that's what gets the fill. If you've probably experienced, the price coming down and sitting on top of your order, and most of the time it's not going to fill you unless it trades through. So as far as managing the trade, 2 points is, I find, adequate for the ES. I actually used to use 1.5 points up until about a year and a half ago, and I widened it just a little bit, just going through my my trade stats and things, and found that 2 points was keeping me in a handful of more trades versus getting stopped out. And then that first target of 3 points is really beneficial. It's larger than my stop, but it's only on half the position. So you can lock in a small gain. You can get your stop to break even, so you're guaranteed a winner at least a small winner, and then still have half the position to trail. The hardest position to trade really is one contract, because you're stuck with making the decision, do I trail or do I arbitrarily set a target? So if your account if you're not able to trade, multiple ES contracts or whatever contract you're trading, I would encourage you to go to the micros at least for a short time. Make 100 trades on the micros. Trading 4 micro ES contracts so that you can get a better feel for managing a position with multiple exit points. Because the goal is obviously not to just trade one ES contract for the rest of your life. You want to get up to 6, 8 contracts so that you have more to work with and you can actually make some decent money and you're not just stuck making $50 and here and there. So then the second half you can trail, and let's say you're trading 4 contracts, you take 2 off at that first target, that gives you 2 contracts left, and you can trail those contracts differently. So you could trail one of them aggressively and then one of them more conservatively. And that's something that, if you're swing trading and you have 500 shares, you can exit at different points. It's not, you don't want to exit 500 shares at 500 different exit points, but it does give you some freedom and some flexibility to, market starts nose diving off a cliff. You can get really aggressive with one of those 2 contracts that you have left, and then the second one you could leave a little more conservative in case you get, a little bit of a bounce, and then you roll over, then you're still in the trade. But what you don't want to do is, go to trading 10 contracts and take 9 of them off for 2 ticks, and then you have one that goes to 10 points, because your risk to reward is just garbage then. So that about does it for me today. Over at emoneymind.com, if you go to success hacks, I've got a handful of cool little things that I've used over the years for everything from goal setting and little things that have helped me in my trading. You can find those there, and my email is also there on the screen, tim@emoneymind.com. If you have specific questions regarding your situation, your trading, or want to talk about bikes or house remodeling or anything like that. And the session is being recorded. I saw that question, so you will be able to get a copy of it and review that in the future. So thanks everyone for tuning in. I hope everyone has a great rest of your day, and thanks Dave for having me.